Saurabh, good morning. Thank you for joining us. Saurabh, nobody is complaining, but everyone is worried about the spike, the rally, the pace, and the force with which markets have come back post-budget. Do you think the fundamental context of this market, because of strong earnings season and what we've got from the budget, has changed?
I think, Nikunj, it'll be very hard to stop this market. I think even through that 1 month lull that we have going into the budget, where people were losing sleep about the budget and so on, I kept highlighting that in an environment where large companies are showing you 25-35% earnings growth, and we haven't even got into the YOY comparables turning favorable, which happens in the current quarter. In an environment where earnings growth is going to be 25-35% consistently for several quarters to come for large companies, it'll be very difficult to hold back the market. The only circumstance I can see a pullback is inflation comes through strongly, and interest rates therefore have to be hiked both in the Western world and in India. Barring that scenario of inflation pushing through and interest rates therefore rising, anybody out there who's waiting on the sidelines, worrying about valuations and so on, I think life will be difficult. It is one of those things. I mean, we are in a circumstance where for the next 4 quarters, because of the YOY comps now turning favorable, we'll get even better earnings growth than the bumper quarter that we saw in the quarter ending December 2020. So difficult to see what will hold the market back, barring a push through in inflation and interest rates.
Saurabh, let's look at the construct of the economy, which is going to change. The construct of the economy is that corporates are talking about revisiting CAPEX. Some of them are committing to it. Some of them have started planning. That's a big change in what we've seen in last 3-4 years versus what is happening now. Given that the nature of the economy, because of government spending, CAPEX cycle picking up, if that is changing, do you think the profile of the stocks should also change? Because there was a time in the market where markets had to be worried about pristine quality, great capital allocation. But when the economy is opening up very differently, could the market also be looking for different indicators?
I mean, we're clearly going into a part of the economic cycle where CAPEX, which has been subdued in our country for 8-9 years, is clearly picking up. Whether you look at power consumption, truck sales, sale of residential housing units or mortgage disbursals, steel demand, etc. So we're clearly in the early stages of what looks like a 2 to 3 year CAPEX uptick. The question is, how should you play it? There are 2 ways to think about it. One way, the sort of traditional value investing way, is go and buy steel and metals mining, power infrastructure, construction, real estate. And then there is the other way, which is the Marcellus way, which is to say that, look, we know that in sectors which are heavily regulated, metals, power infrastructure, real estate, in sectors which are heavily regulated, it is very, very difficult to generate return on capital well above cost of capital. So we in Marcellus would rather play the economic upcycle through, I would say, three cyclical sectors. Sectors where first up would be auto and auto bank. Second would be the lending construct in our country, banks and BFCs, to a lesser extent the savings place. And the third way to play the macro upcycle, we reckon, is to look at the building materials sector, not metals mining, but building materials in the sense of tiles, pipes, paint, adhesives, and so on. And as we've seen in the December quarter, they're having a bumper run. But my reckoning is building materials is set for a 2 to 3 year bumper run as the real estate cycle turns down. So play the cycle through sectors where there are clean, well-run, high-quality companies with a long track record of high-quality capital allocation. Don't get suckered in by low PE multiples into getting into sectors which are CAPEX friendly, but which have a really troubled history of broken balance sheets and poor governance.
Okay. So that completely sets the tone. I know that you have your key names that in your portfolio that you continue to hold and track. But I wanted to ask you, in terms of the market and the earnings, and yes, we're definitely seeing earnings growth come back and a huge wave going forward. Is there anything that in particular that stands out to you? It's a vast it's a vast canvas, I know, but if you were to pull out maybe a couple of names that you felt surprised on the upside or with the kind of growth that we saw, anything new that you're now actually taking a note of, even if you've still not added it, but have been looking at, post this particular season and now post the context that the budget has set as well?
Sure. So I think let me start with financials. I think in our in my past interactions with the team at ET, now I've discussed that we are adding second-rung financials, and I think I've discussed AU Small Finance Bank, which we have added assiduously over the last 6-7 months steadily into our portfolio. So we are continuing to look at this theme of sort of second-rung lenders, but who are well run, have a good balance sheet, tier one of north of 20%, sometimes in some cases tier one ratios north of 30%, and in that context we have also started adding Aavas financiers. This is a affordable housing finance play. It's primarily focused on northwestern India, ticket sizes of 8, 9, 10 lakhs. Part of the AU Finance table, used to be part of the AU Finance table, subsequently AU Finance, when it became a bank, had to sell its stake, and it's now owned by 2 private equity firms for the most part. So Aavas Financiers is another smaller financials name that we're adding, and we'll carry on doing this. We've been very clear through last summer that this is the time over the next 3, 4, 5 years. There's a lot of money to be made in India by investing in high quality lenders and high quality savings plays. AU Finance, Aavas are part of that strategy for Marcellus. We've also obviously had the traditional names, HDFC Bank, Kotak Bank, Axis Bank, and so on, but we're adding the second rung lenders. The second space where we very enthusiastically increased our positions through 2020 was auto and auto ancillaries. We added sort of familiar names such as Maruti Suzuki, such as Eicher Motors, but we also added smaller auto ancillaries, and we have fairly substantial positions there in companies like Sterling Tools, Suprajit Engineering, Lumax Industries, and so on. And I think this is a theme where we are very confident that over the next 1 or 2 years, even if EV makes a meaningful entry into the Indian landscape, we are adding these sorts of firms where we think that in spite of EV, you will need car headlights, hence you will need Lumax. Even with EV, you will need a degree of fasteners in your car, and hence you will need Sterling Tools. So auto Anch remains, I think, an exciting space. And the third area where I've discussed on your channel, I think for the last year and a half, but I think we have to confess, even we've been surprised on the upside, is specialty chemicals. It's increasingly evident that the West and China wants to reduce production of spec chem because they believe there's environmental hazards associated with it. That spec chem production will have to go somewhere. It looks to us that a big part of global spec chem production is coming to India. We've had in our portfolio names such as Divi's in the API space and alkylamines and GMM Pfaudler. We're looking to add a few more names. We're doing some more research. Give us another month. We're doing some more research to figure out what other names can we add to the specialty chemical piece. There seems to be enormous demand visibility here, as is evident actually in the sort of the most obvious way to play it, which is to play the main supplier of this industry, GMM Pfaudler. But their results give you a lot of visibility that next 1 year, 1.5 years, demand pipelines, the production pipelines are full for the spec chem industry, and we're looking for other ways to monetize this. Yes, the traditional ways of cement and road construction and real estate are there, but we've had long had concerns on are there really comparative advantage to be built in sectors like that, and there's governance issues as well, which I hinted at a couple of minutes back. So our favored way, look good quality lenders, auto ancillaries, spec chem, our traditional building material favorites continue, Astral Poly, Asian Paints, Pidilite, Berger Paints. Those are traditional sort of Marcellus favorites. We continue with those.
All right, fair enough. Saurabh, what about pharma? The API theme, of course, continuing. You've been quite bullish on the export market as well and expecting pharma to do well. Give us your latest take on that and the kind of opportunity that you continue to see some of these pharma majors having and how you're perhaps looking into the pharma back.
So in pharma, the 2 companies where we've had meaningful stakes over the last couple of years would be Divi's Lab and Abbott Laboratories. So in Divi's case, it's more a play on API rather than pharma per se. Divi's does not make the formulation; it supplies the APIs, active pharmaceutical ingredients, which goes into the formulations. And I think all credit to the firm. This was already a well-run firm even till a couple of years back. In the last couple of years, I think they've consolidated their position as one of the leading API suppliers in the world. They've announced further CAPEX. I think just 3 months ago, they announced further CAPEX. And I think a steady 20% compounding in this company should be possible over the next 5, 6, 7 years. So amongst the sort of export-centric pharma plays, Divi's remains our chosen play. Amongst the domestic pharma construct, we've seen Abbott as the most moated of the domestic pharma plays. The stable of products that they've had for the last 8, 9 years, and the Abbott sort of revival started 8, 9 years ago. The stable of products that they've had has been sort of without comparison in the domestic landscape. And the main challenge we're trying to sort of deal with here is the FII holding is capped out at 75%. So already the FII ceiling has been hit. And obviously with FII money not being able to come in, the stock has flatlined over the last 8, 9 months. Ironically, that means a domestic investor like us can buy more than the foreign investors can, and we've taken full advantage of that. Whilst recent results this quarter was basically a flat quarter, our reckoning is the Abbott franchise in India has enormous potential, and my reckoning is they'll keep bringing better products from their Western stables and adding it to the formidable lineup they have in India. So domestic pharma, Abbott, and the export-centric pharma, Divi's has been our way to play it. Beyond that, the other Indian pharma companies, honestly, we've looked at them long and hard, but not been able to fully convince ourselves that we fully understand the numerous moving parts that sit inside the other large Indian pharma companies.
Saurabh, you just expressed your thoughts that how you are adding new names to your portfolio while you still continue to like the Kotaks and the Berger Paints of the world. So are you looking at expanding the number of stocks in your portfolio? Because if you're not selling what you've liked in the past, if you're adding new names, are you looking at running a slightly more diversified and a less concentrated portfolio now?
So Nikunj, I guess there's two things that are playing out. One is, flows into Marcellus have been very, very strong over the last 12 months. So obviously, as the monies that we are managing now sort of basically move towards the $1 billion mark, we're perforce having to add a few more stocks because there's only so much you can buy in a name. And many of the names that we own, we are already accounting for a substantial part of the free float. And, it's a little uncomfortable once you start accounting for a significant part of the free float. So as the flows into Marcellus burgeon, we're having to add a few more names just to make sure that we don't end up accounting for a big chunk of the free float in the investee companies that we have. The second reason for adding new stocks was a couple of years ago, we launched the small cap portfolio, Little Champs, where many of the spec chem names and the auto ancillary names that I was just highlighting, we discovered those names, the specialty chemicals names like say alkylamines, the auto ancillary names such as Lumax, we discovered in that Little Champs portfolio. We shut that to inflows in July last year. And July last year, we opened a third strategy, which is Kings of Capital, the lending-focused, asset management, insurance-focused strategy. So the way we have added names primarily is actually by figuring out what will do well over the next 2, 3, 4 years and launching a specific portfolio dedicated to that. So August 19, we launched Little Champs, the small cap portfolio. July 20, we launched Kings of Capital, and that's how the expansion has come. So Aavas Financiers goes into Little Champs, it goes into Kings of Capital, and we sort of did this very consciously. We realized that the economic cycle was bottoming out. In a way, COVID made it actually very easy to figure out that the economic cycle was bottoming out, and we therefore added small caps and financials as a way to play the reflation in the economic cycle. The consistent compounders, the traditional Marcellus flagship strategy continues with Kotak and HDFC Bank and Asian and Berger, the sort of traditional Marcellus favorites. So if you might want to see it as a core and satellite strategy, the core names remain the traditional Marcellus names, HDFC Bank, Kotak Bank, Asian Paints, Berger Paints, and then the satellite names, Little Champs and the Kings of Capital names that we've discussed over the last 10 minutes.
Great point. So let's talk about the core strategy. Satellite strategy we've discussed, specialty chemical, auto ancillary, small financials. When the economy is going to change, a point which we discussed, do you think some of the classic compounders can get into time-wise correction? Because there is a limited scope for Asian Paint P multiple to expand even if growth is strong. A classic example, you know more than me, is the HUL example, that it was a great company, but between 1995 and 2000, it did not give any great returns. Could the Asian Paints and the other classic compounders go through this 2-3 year phase of time-wise correction?
Right. So this is a subject that one can look at very carefully. There's plenty of data on this. What India's history suggests is that, say, in a raging bull market, 2004 to 2008, let's take that period. I think in those 4 years before the Lehman correction set in those 4 years, I think the Sensex compounded around 30% actually, 30%, north of 25%. Those 4 years, the Sensex or Nifty consistently gunned out north of 30%. In that sort of climate, these traditional names in Asian Paints or a Pidilite type portfolio still gave you 23-24%, which to my mind is very good going. Obviously, you're underperforming because in a raging CAPEX cycle like 04 to 08, in a raging CAPEX cycle 04 to 08, the market is giving you 30-35. And Asian Paints can't give you 30-35, right? It's not going to be in a raging CAPEX cycle. It can't give you 30-35. Neither can a Pidilite, nor can a Berger Paints, nor can a Divi's Lab for that most part. So we are happy in that part of the cycle to have 20-25. And that's when the satellite piece comes in. In the satellite part of the portfolio, in your small cap portfolio, if you have high quality small cap names which are compounding at 30-35%, and if in your financials portfolio, in your lending portfolio, if you have good lenders, smaller lenders, asset managers, insurers who are giving you good compounding, then you're more than able to keep up with the market without giving up on your core names. The reason you should keep the core portfolio, these very high quality compounders, is in a pullback like Lehman, like COVID, like the dot-com bust, these names such as Nestle, Asian Paints, Pidilite, they give you enormous downside protection, right? None of us has a crystal ball. We don't exactly know what the next 2 to 3 years hold. We would like to benefit from the economic recovery, but at the same time, we don't want big drawdowns. We don't want a big correction in the portfolio. As soon as you load up the portfolio heavily in metals, mining, real estate, power, infrastructure, construction, you're exposing yourself to a major drawdown, right? And hence our view has been the core has to be super strong. So let me put it like this. Let me put it in the context of an Indian meal. The dal chawal portfolio has to be high quality compounders with impeccable pedigree. Nestle, Asian Paints, HDFC Bank, Kotak Bank, Berger Paints, and so on. That's the dal chawal. Your sort of main course, your sort of vegetable dish can be one rung down in market cap. So AU Finance, Aavas Financiers, and so on. And then the dessert, your sweet dish can be really well run small caps. The sweet dish has to be had in moderation. The main course also has to be had in a reasonable degree of moderation. The dal chawal stocks, the bread and butter stocks should be 60%, 65% of your portfolio. And that dal chawal for us is our consistent compounders portfolio. Our main course, so to speak, is Kings of Capital. And the sweet dish is our small cap strategy, Little Champs. If you see it like that, it actually logically stacks up. And you get everything in sort of good proportions. You protect the core of your franchise, the core of your portfolio, and generate solid compounding through both bull and bear markets.
Great point, but you're missing on the healthy part, which is pure salad and appetizers. What would be that part of the portfolio?
So I think the salad part of the portfolio, what we are looking to build is, in a way, if you think about the salad part, you're trying to both whet your appetite and have something reasonably healthy. I would say in the salad part of the portfolio, we're looking at building another small and mid cap strategy, where we can combine the best of small and mid cap with some of the stability of say large cap stocks. So I'll give you a couple of sort of salad stocks which I think give you both whet your appetite. You want more of India after you've had these stocks, but they are still fine franchises, powerhouse franchises. Say something like Relaxo or a Dr. Lal Path Labs. These are both franchises at $3 billion or less than $3 billion market cap. They have dominant market shares in their specific niche. So in Relaxo's case, in the low end of the footwear market, I would reckon they have already 20-30% share, but they're not a dominant franchise in the entire footwear market. Dr. Lal Path Labs in the northern Indian region, they have I would say a good fifth to a third of the market, but they're not yet dominant pan-India. So the salad part, the appetizer part would be small and mid-cap companies which have become dominant in specific niches. And what you and I have to do is make a call. Will they be a all India champion? Will they over the next 10 years become a Nestle style franchise, $20-25 billion in market cap with a powerhouse pan-India strategy? I think that's in a way that's sort of one way to combine the best of both possible worlds. You invest in a franchise with great pedigree, great 10-year numbers, historical, and then you look ahead over the next 10 years and say, as our country grows, this said company, a Relaxo or a Dr. Lal, can become 10x in 10 years as they grow into the broader market.
All right, Saurabh, we'll leave it there. Thanks so much for joining us this morning.